All right, so we are going to finish up chapter 6 today. And we're going to talk about these journal entries that are required for the account to enter the payroll information into the accounting system. So we've got 4 kind of main classifications of journal entries that occur. I gave you a little bit of a preview of what those 4 were. I think I talked a little bit about that last week. The first 2 classifications of journal entries occur when we actually pay the employees. So that's what the trigger is for making these journal entries. The first one of those 2, what we're going to do is we're going to record the wage expense of the employer, and then the liabilities for FICA taxes and federal income taxes, state income taxes, any amounts that have been withheld. So you can kind of think of it in terms of, if you think about the gross paycheck, all the withholdings, and the net paycheck, that's what's going to be entered in as the journal entry. The second journal entry that we're going to record occurs at the same time. And this is to record the employer's portion of all of their payroll tax liabilities. So the employer's portion of Social Security tax and Medicare tax, the employer's responsibility for FUTA tax that's related to the paycheck that is, or paychecks that have just been paid. So both of those entries, those first 2 categories of entries, happen every time we pay an employee, whether it's the paying all of the employees because it's a regular paycheck, or maybe we have an employee that's been terminated and we're required to pay them early, pay them at the time that they're terminated. We would make that journal entry at that point as well. So anytime that an employee is paid, both of these journal entries is going to be made. And so we extract the information to make those journal entries from the payroll register. So what we've got here is kind of a little snippet of a payroll register. And in this case, we've just got 2 employees, but obviously we could have hundreds of employees. But what we're looking at, what we're interested in, are the totals for each of these columns. And of course, these columns, we've got all of the amounts of taxes that have been withheld. We also have an entry for insurance. So presumably they've got some health insurance or life insurance or something that the employee is paying the premium for, and that amount is being withheld from their paycheck. And then we have their net paycheck represented. So all of the information for the very first journal entry is listed right here. The first thing, so let's look at the first journal entry. And this would happen, like I said, we're going to make this on the date of payroll. So let's just pretend that payroll is today, 11/25. So we've got our date of 11/25. And we're going to record this information as a journal entry. So we've done all the other stuff that all the other topics that we have covered in this class, we've already calculated. So we've calculated, remember, so chapter 3, we calculated our Social Security and Medicare tax. So we know how to do that. Chapter 4, we calculated our federal income tax and our state income tax. That's from chapter 4. Chapter 5 is that FUTA and SUTA tax, which we'll talk about in the next journal entry here. But we're now to the point where we've got all of that entered, and we have generated a payroll register. So now what we can do is we can take the information in that payroll register and we can put it into the journal entry format. So the first thing we're going to do is, it says here, we're going to debit wage expense. And it might be salaries expense. It might be wage expense, and maybe if this is for one particular department, we want to classify which department it's in. But the name of the account is going to be particular to the company. Whatever they want to name their accounts, they can go ahead and name their accounts whatever they want, whatever makes sense to them. But the first thing, we're going to debit wage expense for the gross amount of payroll. So that $18.45. And remember, so our debits are here, credits are here. Next entry, or series of entries that we are going to make, are all of these amounts that have been withheld, and these are all liabilities. So they're payables. We're going to withhold them from employee paychecks, and then we're going to have to pay it at some point in the future. So we could say OASDI payable for $114.39. And you notice this is only the employee's portion. The employer's portion is going to be part of that second journal entry. And then we've got Medicare tax payable for, we have $26.75. Federal income tax payable, and it is important on this one, you probably want to make sure it's specific to employee federal income tax, because if we are a corporation, we may have our own federal income tax that we have to pay as the company. So you want to distinguish the employee federal income taxes from the corporation's federal income taxes. So we can say employee federal income tax payable for, what do we have, 170? Employee, again, same thing with the state income tax. Make sure you've indicated that it's for the employees, the amounts that have been withheld from the employee paychecks, $50. And then we have maybe insurance withheld. I don't know if they have, I don't know what they're calling it in the so this would be 191. So all of the amounts that have been withheld from the employee paychecks are liability accounts. And then the last, right now we don't balance, right? And we have to balance. So our balancing entry is the amount of cash that is going out, the amount of cash that's actually being paid right now to employees. So $1292.86. So you can tell, so here's an expense account. All of these are liability accounts. And then cash is our asset account. So this is our first journal entry. Again, I've got the date here of and then of course you'd say to record 11/25 payroll. Some sort of description underneath it. And it looks like that. So again, I mean, pretty simple. We're just going to debit that gross payroll, and then the liabilities and the cash going out is going to be our credit, and we balance on both sides to the $1,845. Questions about that first journal entry? Pretty self-explanatory. Again, extract that information from the payroll register. The next journal entry, which is going to be prepared at the same time. So still going to be on today, 11/25. Again, we've got, let's see. So we're going to be, this is going to occur on the same day and same time as this payroll entry, this first payroll entry. All right, so now this is the employer's portion of those taxes. So everything that's related to what the payroll, everything that the employer owes for their portion. So we've got, again, this is just an extension of that payroll register here. So we still have our gross payroll listed here, and this is just sort of to continue it. The real information that we're going to need is from the taxes that are due from the employer. So FUTA taxes, SUTA, OASDI, and HI, those Medicare taxes. The debit in this case is going to be another expense account. We're going to debit the payroll tax expense. So again, we've got another expense account here. But what I recommend is you wait until you've entered the credits to determine what this debit is, because this is essentially a plug. The sum of all of those credits that we're going to enter is going to be what our payroll tax expense ends up being. So we've got FUTA taxes payable, again, in the total amount of $3.69. Again, we learned how to calculate that in Chapter 5. SUTA taxes payable, $46.06. Now the OASDI is just the same amount. So this is the other half, the 6.2% that the employer owes, $114.39. And then the Medicare taxes payable for $26.75. So in this case, we don't have an asset account, but we do have we are hitting expense accounts and liabilities, and a liability account. Our plug is just the sum of all of these amounts. So let's add those up. 9 plus 190.89. Our journal entry looks like that. So again, it's going to happen the date, and again, to record employer payroll taxes. Whatever the description is for the 11/25 payroll. Questions about that second one? Again, fairly easy. The hardest part is calculating what these numbers are, right? It's everything that we did in chapters 3, 4, and 5 to determine what those amounts are going to be. The actual journal entry itself is pretty easy because we've already done the heavy lifting there. And actually what I want to do, I made these too big because I want to put them both, I want to write them both down. Let's do this. So this was, bear with me for a minute. I want to write both of these journal entries down because what we're going to do now is transfer this information to the general ledger, or our T accounts. So if you recall, if you've all taken the principles before, or you're currently taking principles, you know that concept of transferring then the information from the general journal into the general ledger. The general ledger is has all of the accounts listed separately, all of these accounts that we just hit with these journal entries. So let's write I'm going to put these journal entries down again, and then we'll actually one. Okay, so if we recall, like I said, bear with me for just a second. I'm going to write these down again. So we've got our wage expense of $18.45 and OSDI payable, Medicare payable. I realize they've given them different names than I'm giving them. So employee federal income tax payable, Employee state income tax payable. What did they call that? Insurance payments withholding. Okay. And then cash. So 114. 170. 50. 191. And 1290. 286. So there's our first journal entry. Second journal entry on the same day is our payroll tax expenses. So payroll tax, I like to call this payroll tax expense. Personally, I like to indicate that it's an expense. I think it makes it a little bit more clear, but 190.89. Got our ASDI payable 114.39. Payable 26.5. Fuda payable. Suda payable 369. I know mine's out of order what they've got, but that's all right. 06. All right, so there's our two journal entries. And now what it's going to look like to transfer them to the general ledger. So here's our general ledger here, and we're going to write down all of our T accounts. So we got lots of accounts here that we're gonna hit. Each of these has their own T account in the general ledger. So we got wages, expense, OASDI payable, Medicare payable, employee federal income tax payable, employee state income tax payable, insurance withheld, cash. And of course, these are going to be in a different order. We're going to start with our assets, next our liabilities, and to our expense accounts. But just bear with me right now. This is what. So payroll tax expense. Here. And then we've got FUTA payable. Because we've already got OASDI payable up here and Medicare tax payable. So we've already got that one listed. And then SUTA payable. All right. Then all we do is transfer this information from the journal entry into the general ledger. And if it's a debit on the journal entry, it's going to go on the left side in the general ledger, in the T account. If it's a credit, it's going to go on the right-hand side. So we'll start with our wages expense. So $18.45, this is a debit. We can kind of mark it off as we go along. OASDI payable, $114.39. Medicare payable, $26.75. Federal income taxes payable, $170. State income taxes. Insurance. Cash, $1292.86. Now, cash is an asset. Asset normally has a debit balance. That means we would debit to increase it. But here we've got cash going out, so it's going to decrease it, right? Presumably, and hopefully, we had a debit balance to begin with, because otherwise we're going to be overdrawn. We've got cash going out that we don't have in that case, but we'll assume we had some cash to work with. Payroll tax expense, $190.89. then we're going to add another entry here for that employer's portion. Same thing for the Medicare. FUTA and SUTA. Okay, so we have transferred everything from our journal entries, those first couple of journal entries, what are we doing here, into our general ledger or our T accounts. And we can see at a glance, if we look at these liability accounts, we can see that we're going to have to make some payments at some point in the future. Now, the liabilities, when we make those payments, is going to vary depending upon when they're due, right? So remember, our Social Security tax, our Medicare tax, and our federal income tax, those are our 941 taxes. Those are going to be due based on whatever our payment schedule is, our deposit schedule. We may be on a monthly deposit schedule, which means we're going to have to deposit by the 15th of the following month. So probably we would have more payrolls that are where we're accumulating that liability more and more during the month. If we're on a semi-weekly deposit schedule, then we're going to have to deposit it either Wednesday or Friday, depending upon what our payday was. If we're on a next day deposit schedule, then we've got to deposit that the next day, right? So those amounts are going to have their own payment schedule. The state income taxes that are withheld are going to have their own deposit schedule based on the state schedule. Insurance we're probably reimbursing ourselves as the company. We're reimbursing for the amounts that we paid at the beginning of the month. So now we're withholding that from employee paychecks. Our FUTA payable, if we don't get to $500 during the year, then we don't have to deposit this until January 31st of the following year, right? If this, though, accrues to a total of 500 or more, then we're going to have to deposit it on a quarterly basis. SUTA, this is probably going to be deposited on a quarterly basis at the time that we report our SUTA taxes and file those reports with the state. So we've accrued these liabilities here, but we're going to, when we pay them, is going to vary based upon the different payment schedules for these different agencies that we then have to pay. But we've now transferred everything to the general ledger, entered the first two journal entries that were made at the point that we, on our payroll day, right? On the day that we actually paid the employees, we make those two entries. I'm going to come back to the thing about the workers' compensation. And there's a lot of stuff here. Nope. All right. Any questions about those first two journal entries? Okay. The third journal entry that we make, we're going to need the information that's been entered into the general ledger, because the third journal entry occurs when we make one of these payments. So at the point that we pay the Social Security, Medicare, federal income taxes that have been withheld, that's when we're going to make another payment. So again, that third journal entry is going to be triggered when we make some sort of payment. First two were triggered when we paid employees. This third one is triggered when we pay those liabilities that are due. So again, we're going to have cash that's going out. So we can erase this at this point. So let's just say we are a monthly scheduled depositor, and this is the amount that we have accrued for the entire month here. So the totals are listed up here. We've got right now if we look at our general ledger, we owe $228.78 for Social Security taxes that have both been withheld, and that we owe for the company portion. We have Medicare taxes accrued of $53.50. We have federal income taxes accrued of $170. State income taxes accrued of $50. FUTA taxes and SUTA taxes as well. So now, fast forward, and we're going to pay those amounts that are due. Well, if we're a monthly scheduled depositor, we're probably going to owe those, if that accrued as of November 25th, it's going to be due December 15th. So as of December 15th, so here's our third category of journal entries. Okay, it's going to be in the form of several journal entries because we're paying them at different dates, but it's like a category of journal entries for the amounts that we make when we actually pay these liabilities. So on 12/15, we have to pay our Social Security, Medicare, and federal income taxes that have been withheld from employee pay. So we got cash going out, right? That's going to be our credit, will be the amount of cash that we're actually paying. Our debits are going to essentially zero out these amounts that are in these listed in these accounts. So we're going to debit the OASDI payable for $228.78. We're going to debit the Medicare payable for $53.50. We're going to debit the employee federal income taxes payable for $170. And we're going to pay it out in cash. We've got to figure out how much cash we've got to pay out at this point. So plus, so $452.28. All right, and then we make the journal entry, and then we enter it into the general ledger. So now we've got a debit over here for the OASDI payable of $228.78, which essentially gives us a zero balance in that account now. We know we've erased that liability because we paid it. Same thing with the Medicare payable, $53.50. So now we have zero in there. Check those off that we entered them. Employee federal income taxes payable. Now we've got a debit there. So now that's at zero. And we've got more cash coming out. So again, hopefully we've had some other cash coming in, because otherwise we're in trouble. But $452.28 there. All right. The next amount that we had paid, so we've gone ahead and paid these three. Now we've got some state income tax. Let's say that we have to pay that the same day. So now we've got our employee state income tax payable, $50. And we got cash going out again of $50. This is presuming we're paying it on the same day. So now we're going to, where's the, okay, 50. So again, now we're at zero for that. We've got more cash going out for that 50. We have left, let's see, we've got our SUTA. Let's say we have to pay SUTA on, we'll say it's the end of the month. Or actually, probably it would be at the end of the quarter. It would be on a quarterly basis, and so it would be the end of January that we would make that payment. So 131 SUTA payable of 4606, and then cash again 4606. We'd enter this down here. Not that 0. 4606. That's been entered. And then let's say the FUTA, again, we're going to pay that January 31st. We never reached $500. Maybe this is the only payroll that we had. 131 payable and cash. So 369, 369. So now we owe 0 for that at this point. And we've got more cash that's been credited. So again, this is the third category of journal entry that we make at the point that we pay those liabilities. Okay. Again, so they've just got the same ones here listed. So this is our deposit of those 941 taxes, deposit of the state income taxes, the SUTA taxes as well, and then the FUTA taxes. Questions about that third category of journal entry? Nope. All right. You guys are all masters of financial accounting, so that's... Well, I am certainly not. I am a tax person. I am not a financial accounting person. I always have to step back and think when I'm doing this stuff. All right. So again, first, second, and third journal entry, our trigger is we're paying something, either employees or we're paying those liabilities. The fourth category of journal entry is not triggered by the payment of anything. It's triggered by the end of a period. And the purpose behind these are our accounting period does not always match up with our payroll period, right? And a good example of that would actually be here, the end of December. So if you can see at the end of December, we've got an accounting period that ends in the middle of the week. If our payroll period doesn't end until, the middle of the week. If our payroll period doesn't end until maybe the end of the week, we've got a difference between those two periods. Well, as you know, with accounting, we have to match. We have this matching principle. We have to make sure that our expenses match with the period in which they're incurred, right? That's the whole philosophy behind accrual basis accounting, is we are matching those expenses. So even though we haven't paid out the employees at the end of that period, we still owe them at that point. And we have to match the amount that we owe with the correct accounting period. So in order to fix that timing difference, we have to make these adjusting journal entries. And these are pretty simplified. It's not too complex what we have to do in this chapter. It can get a lot more complex if you're incorporating the taxes that are owed and accruing retirement benefits and all sorts of things that can, when you take intermediate accounting part 2, which we don't offer here at DMAC, but if you go on to UNI or to Iowa State or Iowa or any other four-year institution, you would eventually have to take part 2 of intermediate accounting. They get into that in a lot more detail, but we're just looking from a pretty simplified perspective here. So again, all we're doing is we're trying to correct and reconcile for those two different periods, an accounting period and a payroll period that do not match up. So they've got an example here of employees that may be earned $2,400 by the end of December, but they're not going to be paid until January. So this is a good example here. We can pretend that this is our last week of 2025 here. So if we look at our days, we've got Sunday, Monday, Tuesday, Wednesday, Thursday, Saturday, what was it, 28th, 29th, 30, 31, 1, 2, 3. So let's just say that our payday is here, but our accounting period ends here on the 31st. And as of the 31st, our employees have accrued $2,400 of pay that they're due. We're going to have to pay them that, but we're not going to pay them until January. So we've got this $2,400, we'll say 800, 800, 800 was accrued on those days. Well, as of the 31st, we've got to make a journal entry to account for the fact that we've got this wage expense that needs to be entered in 2025 so that it is entered in the proper period, but it's not going to be paid until 2026. So we do this entry of the wage expense is a debit, 2,400. We're not paying cash yet. We've got a payable, so wages payable. And this would be done then on the 31st. So, and as I mentioned here, there's no actual payment, so withholding taxes would not be necessary to compute. In reality, an employer very well might go ahead and accrue those payroll taxes as well. Probably would accrue at least their portion, would accrue their portion of those payroll taxes, right? So that needs to be done at the end of the period. There's another journal entry that is discussed in your book with regard to accruals. And these are things, this is for like vacation pay. So oftentimes, employees will have vacation pay saved up, but they don't take it by the end of the year. But the employer is going to have to pay it out when they actually take it. And so they would accrue those amounts as of the last day of the year. So in this example, we've got vacation benefits of $1,000 that are accrued but not yet paid. And so we would debit that expense for the proper year when it was accrued. And then we would credit the payable account for the $1,000. And it mentions some other retirement benefits, healthcare, pensions, those types of things also would be.
Oh, sorry, I was watching your YouTube video. Oh my gosh. I just subscribed to it now.
Oh, would be, that's right, would be, so those would be other types of accruals. I appreciate. Smash that subscribe button.
Yes,
Yeah, yes. Yep, no problem. So that's the fourth category of journal entries that we have to make, is just those accruals at the end of the accounting period. The trigger for those it's the end of some sort of accounting period. Might be the end of the month, might be the end of the quarter, might be the end of, well, most likely would be at least the end of the year, but just depending upon how frequently the company wants to accrue those expenses. So that said, the last thing I wanted to talk about, I skipped over it here, workers' compensation. Okay, so just a little bit about workers' compensation. It's kind of a weird place for them to just stick this in here, so it's a little bit out of order. Workers' compensation, not to be confused with unemployment insurance. Workers' compensation insurance is a type of insurance employers will purchase. Oftentimes they are mandated to purchase it, and what it does is it covers employees that are injured or made ill while on the job. Also covers for deaths on the job. It can pay out benefits to to survivors if an employee is killed on the job. So workers' compensation, how it's calculated, it's based on classification, employee classification. So just like any other insurance, the higher the risk, the higher the premium is going to be. So if employees who are in high risk occupations like construction there's going to be a higher charge for the premiums for those employees. And for like office workers, it would be they're a lower risk, and so the charge would be lower for those employees. It's usually based though on the wages. So, and at the beginning of the year, you use last year's wage amount. So you would calculate out how much did you pay those high risk employees, how much did you pay the low risk employees, and the premium is going to be based on that. But then at the end of the year, the actual payroll that occurs, there's going to be a reconciliation between what was anticipated, or at least what you based the original premium on, versus what actually happened. So that's how workers' compensation works. There are different laws state by state. It said it's based on employee classification. What else? So the premium, again, it's going to be an expense. It's going to be debited to workers' compensation expense, probably a credit to cash as that premium is paid. Employers will estimate and pay the premiums in advance, but then at the end of the year, a reconciliation is done by the workers' comp company to determine whether there was an overpayment or an underpayment of those workers' compensation premiums. That's all I want to say about that.